All right, this is a super quick video explaining a concept that I believe is important to know before you start dealing with the banks and before you start opening accounts, because it has to do with what happens to your money when you go and deposit it at the bank. So I've got my whiteboard here and I'm going to explain it very simply. So first we have our bank, B for bank. All right, that's in the center of the town. And we have guy number one here who's got $100 cash in his hand and he's gonna go give it to the bank. Perfect. $100 is in the bank now. And in return for keeping his money at the bank's gonna give him a 2% annual interest rate on his money. So 2% interest. Then we've got guy two over here who's in the same situation. He's got 100 and it's going to the bank. $100. So now the bank's sitting at $200. And then same deal, the 2% interest rate. Fair enough. But now the bank is losing money. It's paying interest on those accounts. So the bank is going to go find someone who's looking to borrow money. So we've got guy three over here who is looking to borrow $100. So the bank has $200, so they're able to give out 100 of it to this guy. And in return, he's gonna pay it back, but with a higher interest rate, let's say 8%. But this $100 that's been loaned out, it came from somewhere. It came from guy one and it came from guy two. So let's say the bank took out 50 of their accounts and then gave it to guy one. So that's where the term fractional reserve banking comes in. Essentially, when you go to deposit your money at the bank is only required to keep a fraction of it in their reserves. And the rest they can use to loan out to others and make money. But what happens if, let's say, guy one is like, I want to withdraw my $100 from the bank. The bank has two options. Either if guy three has paid back some of his loan, the bank can use that to repay the $100. Or they can use more of guy two's money to repay the $100. But what if the bank still loans out to guy three, but both guy one and guy two want to withdraw their $100? Well, if the bank can't get guy three to repay his loan, the bank is in trouble. So that's where the term bank runs come in. Essentially, you're running to the bank. Everyone's running to the bank to withdraw their money. And that could cause a bank to collapse because they're not able to repay the people that they're in debt to. So this happened a lot, but then something was introduced, a policy was introduced to stop this from happening a little bit, and it's called deposit insurance. So I'll write it down. Deposit insurance. Oh, okay, whatever. Deposit insurance. Essentially, it's like the government is saying the money that you put in there is safe and is protected, even if the bank is not able to repay it. But it's not all the money, which is the key part. It's only, let's say, up to $100,000 that you put in there is safe. It's going to be repaid no matter what, even if the bank collapses. So that's all I wanted to go over in this video. The term fractional reserve banking. When you put your money in, the bank is only going to keep a certain percent of that money in their reserves, and the rest is going to be loaned out, and they're going to be making money off of it. And if too many people are going to withdraw their money at the same time because they're scared of something happening, let's say, that could cause a bank run, and it could cause a bank to collapse entirely. But that phenomenon happens rarely now because of something called deposit insurance that ensures that most of their money will be safely secured even if the bank can't repay it. Thank you, like and subscribe, and I'll see you later.